This video provides independent geopolitical and economic analysis for information purposes. It's strictly here to use community guidelines. It does not promote war or violence.
It's June 2026, and India just became the single largest buyer of Russian oil in the world. Not by accident, not by surprise, by design. And what makes that sentence matter isn't the headline number, it's what comes underneath it. Because India didn't just buy Russian oil. India built an entire alternative financial architecture specifically to move Russian oil past Western sanctions, and nobody in the West saw it coming until it was already done. That's the story. Not what India's buying, but how India's buying it in a way that breaks every assumption the West had about how sanctions work. If you're tracking energy markets, geopolitics, or the actual mechanics of how the sanctions regime is functioning in real time, hit subscribe because this one moves through several layers, and each one changes how you should think about the next 2 years of global oil. Let me lay out the timeline first because the sequencing is everything. Back in early 2022, right after Russia invaded Ukraine, Western nations moved fast. The European Union banned Russian oil imports by the end of that year. The US had already had sanctions on Russian energy for years. Japan followed. Canada followed. The sanctions looked comprehensive on a map, but there was always one enormous hole in that map, and that hole had a population of 1.4 billion people, and a prime minister named Narendra Modi. India didn't join the sanctions. India, in fact, had been buying Russian crude at a relatively modest clip before the war, somewhere in the neighborhood of 15 to 20 million barrels a month, a small fraction of India's total oil imports, most of which came from the Middle East. But the moment Western buyers started pulling back, something shifted. India didn't announce a pivot. There was no big policy statement. What happened instead was much quieter and much more effective. Indian refineries, the ones that buy crude on the open market to process into fuel, started getting aggressive offers on Russian oil at prices that were getting steeper discounts to the global benchmark. Urals crude, Russia's main export blend, started trading at discounts that went from a few dollars a barrel to sometimes $20, $30, even $40 below what comparable crude was trading at on the global market. Now pause on that number because it's the load-bearing detail here. A $30 discount on a barrel of oil doesn't sound dramatic until you multiply it across millions of barrels a day. Multiply it across India's refining capacity, and you're talking about billions of dollars in savings annually. Billions. Suddenly, the calculus for an Indian refinery wasn't abstract. It was concrete. Buy Russian at a deep discount, or buy Middle Eastern at global prices. The spreadsheets made the choice for them. By the end of 2022, India's oil imports from Russia had nearly tripled. By mid-2023, India had become the second largest buyer of Russian oil globally, behind China. And then something interesting happened. By early 2024, India overtook China. India became number one, the single largest purchaser of Russian crude in the world. And here's the part that nobody predicted because it required India to solve a problem that was supposed to be unsolvable. How do you move that much oil through a sanctions regime? Because remember, Western banks won't touch Russian oil transactions. SWIFT, the international payment system, is off limits for sanctioned Russian entities. And yet, by 2024, Indian refineries were importing roughly 1.5 to 2 million barrels a day of Russian crude. The volume just kept climbing, and the question that should have been asked earlier, the one that matters, is how does that actually happen logistically and financially? What's the mechanism? Here's where it gets into the real story. And I want to slow down on this because the mechanism is the entire game. The answer is something called the shadow fleet. And it's not actually shadowy in the way most people imagine it. It's not secret. It's not hidden. It's completely visible to anyone watching satellite imagery or tracking ship movements. What makes it a shadow fleet is that it operates specifically to move goods around sanctions restrictions. And India, along with several other countries, helped build this infrastructure deliberately, with eyes wide open to what it was for. Here's how it works mechanically. Russia's major oil companies, Rosneft, Gazprom, Neft, and others, they can't use regular oil tankers anymore because most of those tanker companies are Western-owned or Western-insured, and they've retreated from Russian business. So instead, Russia and its trading partners started using a different set of vessels. Ships that are older, that are flagged to countries outside Western jurisdiction, that are operated by companies outside the reach of sanctions. Many of these ships have changed ownership multiple times in the last 4 years, specifically to obscure who actually operates them. Some have had their names changed repeatedly. Some have had their automatic identification system, the tracking system, turned off while moving in certain zones. And India's refineries, they know exactly which ships are moving Russian oil. They've been coordinating with them for over a year at this point. The whole thing is legal on India's end because India never signed on to sanctions. India can buy oil from whoever it wants. So the mechanism looks like this. A Russian oil exporter, let's say Rosneft, puts Russian crude into a shadow fleet tanker. That tanker moves across the ocean toward India. Most of those tankers are physically insured by a company that isn't Western and therefore doesn't answer to Western restrictions. The payment for the oil moves through a complex web of financial intermediaries, many of them based in India, the UAE, and increasingly in China. Indian banks, which aren't sanctioned, facilitate the transactions. No SWIFT, no Western banking system. The oil arrives in India, gets unloaded into Indian refineries, processed into diesel and gasoline, and then India either uses it domestically or re-exports some of it. The entire chain happens outside the view of Western sanction enforcement, and it's all technically legal because none of the parties involved are breaking Indian law. And here's what should genuinely trouble anyone thinking about how sanctions actually work. This isn't a workaround that happened by accident. This is infrastructure that was deliberately built, specifically to move Russian oil through the sanctions barrier. Now let's talk about the scale, because the numbers tell you how complete this pivot actually was. In 2021, before the war, India imported roughly 130 million barrels of Russian crude for the entire year. That was 15 to 20 million barrels a month, a rounding error in India's overall oil consumption. By 2024, India was importing somewhere in the neighborhood of 700 to 750 million barrels of Russian crude annually. That's an increase of nearly 500%, 5 times the volume in less than 3 years. And the pace hasn't slowed down in 2025 and 2026. If anything, it's accelerated. India's total crude oil imports last year were around 4.4 million barrels per day. Of that, roughly 40 to 45% is now Russian crude. Think about that for a second. 45% of India's entire oil supply is coming from Russia. India is not a sanctioning country. India is a non-aligned country with its own economic interests, and it decided those interests aligned with buying Russian oil at prices that were economically unbeatable. But here's where this shifts from just an India story into a story about the entire global oil market and what it means for the sanctions regime itself. The International Energy Agency, the official body that tracks oil markets for the world, puts Russia's oil export earnings at over $19 billion a month, even with output down and even with the so-called price cap in place. The price cap, you should know, is supposed to limit what buyers pay for Russian oil. It's set at $60 a barrel for crude, 44.10 for refined products, and it's almost entirely ineffective. The actual price Russia's getting for Urals crude has been bouncing around in the $75 to $95 range, well above that cap. Why? Because countries like India, which aren't party to the sanctions regime, don't care about the price cap. They'll pay whatever the market price is, which means there's no enforcement mechanism for the cap at all. It's a number that exists on paper, and that's about it. So Russia's getting paid market prices for its oil. It's exporting record volumes, and it's doing it through a logistics network that doesn't depend on Western banks, Western shipping insurance, or Western payment systems. The entire financial architecture of Western sanctions assumes that you can choke off access to global banking and shipping. But India just demonstrated you can move hundreds of millions of barrels through a parallel system and bypass that chokehold almost entirely. Let me pull back here to the geopolitical layer because this is the part that most analysis misses. India's pivot to Russian oil didn't happen in a vacuum. It happened at the exact moment when Modi's government was making a larger calculation about India's strategic position in a multipolar world. India is the world's fifth largest economy. It's not aligned with the West. It's not aligned with China. It's playing a careful balancing act, trying to develop relationships with both while committing fully to neither. And buying Russian oil at a steep discount fits perfectly into that strategy because it gets India several things simultaneously. First, energy security. India's energy demand is growing faster than almost any other major economy. Manufacturing is expanding. People are getting cars, electricity consumption is climbing, and India needs oil, lots of it. Russia was offering it cheaper than almost anywhere else. That's a straightforward economic calculation. Second, political leverage. By becoming Russia's largest oil customer, India gained the ability to have conversations with Moscow that wouldn't be possible otherwise. And India has been using that leverage. Modi met with Putin in 2024. India's been careful in UN votes about Russia's invasion of Ukraine, abstaining rather than supporting Russia, but also not fully condemning it. India's position is basically, we're your biggest oil customer now, we're your friend, but we're not joining your war. That's a position that India wouldn't have if it had joined Western sanctions. Third, and this is maybe the most important part, India was hedging against Western influence. The West spent decades assuming countries like India would eventually align with the US-led order, but India under Modi has been increasingly skeptical of that alignment. Buying Russian oil at discounts that undercut Western pricing power was a way of saying, we're independent, we make our own choices, and we're not going to let Western sanctions policy dictate our energy choices. It was geopolitical signaling wrapped in an economic transaction. And fourth, there's the financial angle that most people miss. India's refineries make money on the difference between what they pay for crude and what they sell refined products for. By buying Russian oil at $30, $40 discounts to global prices, Indian refineries can process it into diesel and gasoline and compete on global markets in a way they couldn't if they were paying global prices. Indian refined products have become more competitive globally specifically because of this discount. That ripples into India's export economy, its currency, its entire refining sector. This isn't a favor to Russia. This is India optimizing for its own benefit. Now here's where this gets uncomfortable for anyone watching Western economic policy. The entire sanctions regime on Russia was predicated on one assumption, that if you could cut Russia off from Western financial systems, Western shipping, Western insurance, Western energy markets, you could strangle the Russian economy into submission. But what India demonstrated is that assumption has a huge flaw. It assumes that Western financial systems are the only financial systems that matter. It assumes that the countries that have signed on to sanctions represent a large enough economic bloc to isolate Russia. But they don't. Not really. Russia's the world's 11th largest economy by most measures. China's the second largest. India is the fifth largest. Together they represent something close to a third of global GDP. And none of them are fully aligned with Western sanctions. China's been buying Russian oil and gas. India's been buying Russian oil. Both countries are also developing payment systems, financial networks, and trading relationships that don't depend on Western infrastructure. The Belt and Road Initiative, the Asian Infrastructure Investment Bank, the Shanghai Cooperation Organization, the BRICS currency experiments. There's a parallel financial system being built, piece by piece, and it's not theoretical, it's operational. So what does that actually mean for global oil markets and energy prices going forward? In the short term, probably not as much as people think. Global oil prices are still set mostly on Western exchanges by Western traders. Brent crude still trades in dollars, but the floor under Russian crude pricing is being set by Indian, Chinese, and other non-Western buyers. Russia doesn't need to sell oil to Europe anymore. Europe's cut itself off from Russian supply. Russia's entire export strategy has pivoted to Asia, and Asia's offering prices that, while discounted, are high enough to fund Russia's entire wartime budget. The International Energy Agency estimates Russia's fiscal budget for 2025 depends on oil revenues sitting around that $80 to $90 a barrel range. Russia's getting that. Not consistently, not every single barrel, but in aggregate, the prices are holding above that line. And as long as they do, Russia can fund the war indefinitely. Not comfortably, not without the economy straining, but indefinitely. Which means there's no scenario where Western sanctions starve Russia of the energy revenues it needs to keep fighting in Ukraine. That ship sailed the moment India decided to buy Russian oil at discounts that made economic sense. Let me lay out what this actually means for someone watching energy markets, because this is the part that matters for your own decisions. First, global oil prices are now going to be set by a combination of two things. 1. Western demand and Western price expectations. 2. Asian demand and Asian willingness to buy Russian at discounts. That second factor is a price floor. As long as Asian demand is strong and India and China are willing to buy Russian crude, global prices can't collapse too far because there's always that buyer in the background willing to step in at these discount levels. It creates a weird dynamic where downside is capped but upside is unlimited if something disrupts supply from Saudi Arabia or other OPEC producers. Second, watch refineries. Indian refineries have become essentially the processing hub for Russian oil. If you're tracking energy stocks or energy markets, you need to understand that Indian refining margins are benefiting from this discount structure. Companies like Reliance Industries, which operate some of the world's largest refineries, they're processing Russian crude and competing on global markets at better margins than they would be otherwise. That's a structural advantage that probably lasts for several years. Third, watch alternative payment systems. India and China are quietly developing payment systems that don't use dollars or Western banking. The BRICS nations have been talking about a new currency unit. China's been pushing for yuan-denominated oil trading. These aren't going to replace the dollar system overnight, but they're creating optionality. And optionality for countries outside the Western sanctions regime is exactly the thing that makes sanctions less effective over time. Here's the uncomfortable layer that most financial commentators won't say out loud, and I think it's worth sitting with. The sanctions on Russia were supposed to be a tool for constraining Russia without military confrontation. But what they've actually done is accelerated India's pivot away from Western energy markets and toward Russian energy. And in doing that, they've made Russia's entire economic model more dependent on non-Western buyers and less dependent on the West, which means Russia is now less vulnerable to Western pressure, not more. It's a perverse outcome. The policy designed to isolate Russia has instead pushed Russia toward deeper integration with Asia. And from India's perspective, it's a home run. India gets cheap oil, energy security, political independence, and improved refining margins. India also gets closer relationships with Russia, which gives Modi more leverage in global diplomacy. And India does all of this while maintaining its official position of neutrality on the Ukraine war. India's voting patterns at the UN haven't changed. India's not sending weapons to Russia, but India is being Russia's biggest customer. Now, the question I'd watch going forward isn't whether this pivot is stable. It is. India's got the refining capacity, the cash, and the strategic incentive to keep buying Russian oil indefinitely. The question is whether this becomes a template. Does this show other countries that there's a way to operate around Western sanctions? To build alternative financial networks? To buy from sanctioned countries if the economics make sense? Because if the answer is yes, and if other countries start replicating India's playbook with other sanctioned producers or with other commodity chains, then what you're looking at is the slow erosion of Western sanctions effectiveness across the board. Not a dramatic collapse, not a sudden shift. Just a gradual realization that the West doesn't control as much of the global economy as it assumed, and that countries will make their own choices if the incentives are strong enough. Here's the thing that bothers me about this situation, and I'll be direct about it. The sanctions regime wasn't built to fail. It was built on sound economic logic. Cut an economy off from global finance, global shipping, global markets, and it should suffer. But what the India pivot demonstrates is that logic only works if the country doing the sanctions represents a majority of the relevant markets. The West represents a large share of global GDP, but not all of it. And the countries outside the West, the ones choosing not to sanction Russia, they represent enough economic mass to be alternative buyers and alternative financial networks. That's a structural problem with the entire sanctions regime that no amount of policy tweaking can fix. So, where does this leave global energy markets 6 months from now, a year from now? Watch for 3 things. First, watch whether Russia's oil export volumes hold steady or climb higher. If they climb, that tells you the shadow fleet infrastructure is expanding and becoming more efficient. If they hold steady, that tells you India and other non-Western buyers have absorbed all the Russian oil they need at current prices, and there's no more room for growth. Second, watch Indian refining margins. If they stay elevated relative to global refining margins, that's a sign the discount structure on Russian oil is persistent. If they compress back toward global norms, that's a sign the discount is fading and Russian oil pricing is normalizing. Third, and maybe most important, watch whether other countries start moving in the same direction. Does Vietnam start buying more Russian oil? Do other Southeast Asian countries? Do African countries? Because if the India model becomes a template, if other countries see that you can build alternative payment networks and source sanctioned commodities without suffering Western retaliation, then you're looking at the slow dissolution of the entire sanctions regime. Not all at once, not dramatically, but piece by piece, buyer by buyer. Let me be clear about something because I don't want to oversell certainty I don't have. India's oil pivot doesn't mean Western sanctions failed entirely. Sanctions on Russia have disrupted military supply chains, technology flows, and parts of the financial system. Russia's economy is smaller than it would be without sanctions. But on the energy front, which is the revenue foundation of Russia's entire wartime economy, sanctions have proven less effective than policymakers hoped. And India is the reason why. The deeper question sitting underneath all of this is whether you can maintain a meaningful sanctions regime in a world where economic power is genuinely multipolar. Where China's the world's second largest economy, India's the fifth, and neither of them are aligned with the West. My honest answer is no. You can't. At best, you can constrain the sanctioned country on the margins, but you can't strangle it if it has alternative buyers willing to work with it, and that's the world we're in now. So watch this space because it's telling you something important about how the next 20 years of global economics are going to work. The era where the US and Europe could unilaterally shape global commerce is ending. The era where rising powers like India can build their own strategies and make their own choices is beginning. And India's oil pivot is one of the clearest examples of that shift in real time.